Padini Holding Berhad is a leading retail company in Malaysia specializing in the fashion retail industry with a rich history dating back to 1971. The company has established itself as a prominent player in the market. Padini Holding operates a diverse portfolio of retail brands including Padini, Brands Outlet, Seed, Binti, and more, offering a wide range of clothing, accessories, and footwear. Known for its fashion-forward design and affordable pricing, Padini Holding has built a strong reputation for delivering quality product to its customers. The company takes pride in its extensive retail network with stores strategically located across Malaysia, providing easy access to its diverse customer base.
The first one is current ratio. Most of the time, the bigger current ratio is a good thing because it shows that the company has more money to cover its debt. But if the current ratio is too high, it could mean that the business is not making a good use of its asset. In this case, Padini Holding Berhad had a significant liquidity before COVID-19 pandemic with a current ratio of 3.92 times. The company maintained a 4.10 current ratio in 2020, despite the poor economy. It handled its epidemic short-term well. The current ratio increased to 5.4 times in 2021 because the economic strengthened, indicate that the short-term obligation could easily repaid. But in 2022, the current ratio slightly decreased, which showed that there was slightly drop in liquidity because of increase of trade and other payable. Padini Holding Berhad can improve account payable by monitor payment due dates and centralize account payable. Next, asset test ratio is to measure company's ability to pay off its current liability using most liquid asset. During economic crisis in 2019 and 2020, Padini Holdings Berhad asset test ratio are only 2.58 and could only partially cover short-term debts. And the asset test ratio increased to 3.92 times in 2021 as the economy improved. This improved liquidity and short-term obligation of Padini Holding Berhad. However, it decreased to 3.90 times in 2020. Asset test ratio is increased because of better management of current asset and strong cash management. Padini Holdings Berhad account receivable turnover in days show how long it takes for the company to get paid by its customer. In 2019, they only have to wait for 12 days on average to get paid, which was good. But during COVID-19 disaster in 2020, it took them for 14 days to collect its payment from customer. This could be because of the economy was uncertain at that time. The time to get paid by the customer went up to 17 days in 2021. Luckily, in 2022, it went back to the 14 days. Padini Holdings Berhad improved this by strengthening their credit rules and offer incentive for early payment. Next, day sales of inventory ratio. Before COVID-19, Padini Holdings Berhad inventory was liquidated in 3 months. In 2020, the ratio increased to 122 days, indicate a slower inventory turnover. This is because of supply chain challenges, customer indifference, and temporary store closing. As economic recovered from pandemic, the ratio remained high at 125 days in 2021. However, in 2022, day sales of inventory decreased to 62 days. This improvement because of Padini Holding Berhad implement a inventory optimization, market analysis, and demand forecasting for their company and inventory. The operating cycle measures the average number of days it takes for the company to convert its inventory to cash through sales. COVID-19 changed the operational cycle number of Padini Holdings Berhad. Operating cycle took 102 days in 2019, and in 2020, the operating cycle increased to 137 days, decreasing in inventory turnover and cash conversion. In 2021, the operating cycle reached 157 days, indicating inventory and cash flow issue. But in 2022, the operating cycle dropped to 94 days, indicate operating cycle is improving and demand forecasting and customer relationship management should be improved to match the inventory level and expected sales of the Padini Holdings Berhad. Free cash flow reflects the company's ability to create cash from its core business and use it for investment, debt reduction, and dividend. After the pandemic, as we can see, free cash flow of Padini Holdings Berhad increased significantly. This is because of the profit. The profit for 2022 is increased by 130 million. This big jump can be attributed to a rise in customer demand, better operational efficiency, good cost management strategy by the company.
During the pre-COVID-19, which is 2019, the debt ratio was 22.53%, indicate that the company had relatively low level of debt compared to its total asset. This suggests a conservative financial structure with a lower risk of insolvency. During COVID-19, which is 2020, the debt ratio increased to 45.2%. This suggests that the company took on more debt to navigate the challenges and uncertainties brought about the pandemic. It could indicate that the company needed additional funds to cover operational costs, maintain liquidity, or invest in new strategy to adapt to the changing business landscape. Last is 2021 to 2022, which is the post-COVID-19. The debt ratio remains elevated compared to the pre-COVID-19 period, but decreased slightly compared to 2020. In 2021, the ratio was 37.9%, and in 2022, it was 40.36%. This ratio shows that the company has managed to reduce its debt burden to some extent, but it is still carrying a relatively higher level of debt compared to the pre-pandemic period. During 2019, the debt to equity ratio was 29.7%, indicate that the company had a moderate level of debt relative to its equity. This shows a balanced capital structure with a reasonable amount of leverage. In 2022, the debt to equity ratio increased to 82.5% because of a substantial increase in the company reliance of debt financing compared to the equity. The higher ratio shows that the company took on more debt during the pandemic to support its operation and manage the financial difficulties. In the 2021 and 2022, which is post-COVID-19, the ratio remained elevated compared to the pre-COVID, but decreased slightly compared to 2022. In 2021, the ratio 58.96%, and in 2022, it was 67.67%. These ratios are because the company has managed to reduce its reliance on debt financing, but it is still carrying a relatively higher debt burden compared to the pre-pandemic period. In 2019, the time interest earned was 118 time, indicate that the company had a very strong ability to cover its interest expenses. The company generated a significant amount of recurring earnings relative to its interest obligation, providing a comfortable to meet its debt servicing requirement. In 2022, it decreased to 3.11 times, a substantial decline in the company's ability to cover its interest expenses during the pandemic. The ratio indicates that the company's recurring earnings were only able to cover its interest expenses appropriately 3 times over. This could be attributed to various factors such as decrease in revenue, increase in operating costs, decline in profitability due to the impact of the pandemic. During the post-COVID, the TIE ratio remained low compared to the pre-COVID. In 2021, the ratio was 2.51 times, and in 2022, it increased to 9.6 times. It shows that Padini's ability to cover its interest expenses improved in 2022, but remained lower compared to the pre-pandemic period. In 2019, Padini achieved a net profit margin of 8.98% driven by e-commerce growth. But due to temporary store closure during the COVID-19 pandemic, the net profit declined to 5.54% in 2020. Despite challenging conditions, Padini maintained a stable net profit margin of 5.25% in 2021, benefiting from reduced consumer spending and government support. In 2022, the net profit margin significantly improved to 11.68% as lockdown measures eased, vaccination progress was made, and consumer spending rebounded. Padini Holding net profit margin fluctuated over the years but showcased resilience and growth. The company effectively adapted to challenges and capitalized on opportunity, culminating in strong net profit margin in 2022. In 2019, Padini Holding achieved a solid operating income margin of 12.4%. This was a result of effective expenses management and the company's ability to navigate the unresolved trade tension between the US and China from affecting the company. However, in 2020, the operating income margin declined to 9.84% due to the significant impact of the COVID-19 pandemic. Padini Holding faced lower profit and increased expenses such as the continuous disinfection of premises to ensure the safety of its customer and employee. Despite the challenges posed by the pandemic, Padini Holding displayed resilience by maintaining a steady operating income margin of 9.24% in 2021. The company actively managed disrupted supply chains and addressed logistic issues to sustain its operation. With the acceleration of vaccination effort and the reopening of the economy, Padini Holding experienced a remarkable rebound in 2022. The company achieved an impressive operating income margin of 70.02%. This recovery can be attributed to various factors. In 2019, Padini Holding achieved an impressive ROA of 70.04%, driven by strategic expansion and business growth. However, the pandemic severely affected Padini Holdings in 2020, leading to temporary closure and limited access utilization. Consequently, the return on asset declined significantly. The decline continued in 2021 with a recorded ROA of 4.05%. The company's decision to close stores resulted in higher asset write-off, contributing to the lower ROA. In 2022, Padini Holdings saw a slight improvement with an ROA of 11.30%. This suggests a recovery in sales and a higher return on their asset investment. In 2019, Padini Holding achieved a moderate ROE of 5.75%, signifying a reasonable return on investment for shareholders. Despite facing competition from online sellers due to the rise of e-commerce, the company managed to deliver satisfactory returns. However, in 2020, the company encountered substantial challenges as a result of lockdown measures and reduced consumer spending. Consequently, the ROA plummeted to 2.5%. This downward trend persisted in 2021 with an ROE of 1.72%, highlighting the ongoing difficulty and diminished profitability faced by Padini Holding. To address these challenges and enhance ROE, Padini Holdings implemented strategic measures, including streamlining operations through store closure. This decision laid the foundation for a remarkable recovery in 2022, with the ROE surging to an impressive 80.21%. This substantial improvement in profitability and efficiency showcased the company's ability to generate higher returns for its shareholders. The increase in net income and earnings per share attributed to equity shareholders further substantiated Padini Holding effective utilization of shareholder capital and its successful rebound from the challenges it faced.
For a pre-COVID time, the PE ratio is at 28.51 times, where we can put it as the base year. Here we can say that the PE ratio is relatively moderate throughout this year. It reflects the market sentiment and expectations before the COVID-19 pandemic. Besides, during this pre-COVID, Padini Holding Berhad was operating under normal business conditions. During the COVID times, the PE ratio in the years of 2020 and 2021 has increased significantly from 63.17 times to 96.47 times because the investors may have had a sense of optimism and resilience as businesses adapted to the challenges posed by COVID-19. The optimism might have been driven by factors such as the company's online sales growth, cost-cutting measures, or expectations of a pent-up demand surge once restrictions were lifted. Such factors could have contributed to the higher PE ratio. Besides, as lockdown measures eased or become more targeted, there may have been an expectation of a stronger recovery in consumer spending. Investors might have anticipated increased foot traffic and sales for Padini Holding Berhad's physical stores. This expectation of improved earnings could have led to a higher PE ratio. The PE ratio has decreased to 28.31 times during the post-COVID because it might be caused by the consumer behavior and market changes, which can be a reason of reassessment of earnings expectations as the company operated in the post-COVID environment and ongoing restrictions, reduced consumer confidence, and potential disruptions because, as we all know, the MCO where all consumers tend to just do online shopping and stuff. Apart from that, with the continuation of intermittent lockdowns and uncertainty surrounding the pandemic's trajectory, investors may have taken a more cautious stance in their earning projections. Concerns about ongoing restrictions, reduced consumer confidence, and potential disruptions to the company's operations could have contributed to a decrease in a PE ratio. Next is recommendation can be made where it essential for Padini maintain financial discipline and efficient cost management practices by monitoring and optimizing expenses, inventory management, and cash flow. During pre-COVID, the dividend per share has a high percentage, which at 11.5%. From this analysis, Padini Holding Berhad might have a stable operating environment demonstrating strong financial performance, leading to a higher dividend percentage. The company likely enjoyed a stable operating environment, which allowed them to distribute a higher percentage of profits as dividends to shareholders. Next, we move on to the analysis of dividend per share during COVID. As per shown in the graph, the percentage of dividend per share Padini Holdings Berhad has decreased from 7.5% to 2.5%. From this analysis, we can say that during COVID, the company may have received an impact of the COVID-19 pandemic. The pandemic brought economic uncertainties and disruptions to the retail industry, which affecting Padini's revenue and profitability. As a result, the company may face lower dividend percentages and reduction in dividend payouts to conserve cash and maintain financial stability during challenging times. This is because Padini Holding Berhad may have opted to prioritize reinvesting in the business or maintaining a stronger cash position, resulting in a lower dividend percentage. Next is during post-COVID. Now we look at the percentage of the post-COVID. It has increased at 10%, which we can say that Padini Holdings Berhad has improved its financial performance and market conditions. As the global economy recovered from the pandemic and consumer spending rebounded, Padini Holding Berhad's revenue and profitability may have improved. With a more positive outlook, the company could have increased dividend payouts to reward shareholders for their continued investment. Next is recommendation. Recommendation that can be made where Padini Holdings Berhad may adopt a prudent dividend policy that takes into account the company's cash flow, profitability. The dividend yield during the pre-COVID at 1.66% indicates that shareholders receive a relatively moderate return on their investment through dividends, and it likely maintained stable dividend payouts and had a steady stock price during this period, which reflecting a stable operating environment. The dividend yield could be influenced by factors such as the company's earnings, dividend payout ratio, and stock price performance. In 2019, Padini Holdings Berhad may have maintained a stable dividend payout while experiencing a steady stock price. Next, the dividend yield declined in the year 2020 and 2021 from 1.04% to 0.32%, which may cause the retail industry to face disruptions and economic uncertainties, which lead to potential challenges for Padini holding Berhad's revenue and profitability. Due to the pandemic's impact on the retail industry, the company may have reduced its dividend payouts, resulting in a lower yield. Because of ongoing effects of the pandemic and associated restrictions, Padini Holdings Berhad may have prioritized cash preservation and maintain its financial stability to run the business. Moving on, the dividend yield for the post-COVID has increased at 1.51% as the company's financial performance improved alongside the global economic recovery, which impact the consumer spending. Padini Holding Berhad may have increased dividend payouts to align with improved earnings, indicate a positive outlook for shareholders. Besides, the dividend yield has increased because of the continued investment for the shareholders. For the recommendation part, Padini should carefully evaluate investment opportunities to ensure a balanced approach between dividend distributions and reinvestment in the business.
There have been a significant decrease in the value of PPE, dropping to 57.66 in 2022, and the value of intangible asset has declined to 57.8%. Investment property has remained stable, experiencing a slight increase to 103 in 2022. Other investments substantially increased, an unusual high 122% in 2022, suggesting significant changes or growth in this asset class. Deferred tax asset has been substantially increases over the year, reaching 368%. Turning to current liability, trade and other payable decreased but then rose to 105% in 2022. Borrowing experienced a significant reduction to 0%, indicate that the complete repayment of borrowing. Contract liability shows an initial increase but slightly declined to 141%. Provision for restoration costs increased to 157 in 2022, signifying a growth in the company's provision for restoration.
NCA actually fluctuated over the years. In 2019, NCA is at 50.33%, because of lower proportion of long-term asset, while in 2020, NCA increased to 45.30% due to FAR670 leases adoption and recognition of ROU asset. This adoption led to a substantial increase in the NCA by RM484.4 million. In 2021, NCA decreased to 37.2% due to depreciation and write-off. 2020, NCA percentage further decreased to 32.81%. Current asset, now let's go to the current asset. Current asset actually fluctuated too. In 2019, current asset is at 84.69%, indicating a strong liquidity. But in 2020, the current asset dropped to 44.93% due to lower consumer spending during the pandemic. Thus the liquidity weaker. So there is a slow increase in 2021 and 2022, but the increase is because of the help from the government financial assistance itself. For the equity, in 2019, the equity is the highest, which shows that higher equity indicates a healthier financial position. In 2020, equity actually decreased due to lower revenue generation, while in 2021, there is actually slight increase in equity from the measure of the Padini holding to optimize working capital. However, in 2022, there is decrease in equity due to the reduction in lease liability. From 2019 to 2022, the gross profit varied, but these numbers show that the company has made money after taking into account the cost of think it has so. Even though COVID-19 was spreading, the company gross profit stayed the same, which showed that it was able to control production cost and price of the product. Profit from operation. In 2019, the profit from business was 12.40%. In 2021, it was 9.25%, and in 2022, it was 17.2%. In 2020 and 2021, the COVID-19 pandemic caused people to spend less, mess up supply line, and raise business costs. But the company recovered in 2022, showed that it was able to change and use good strategy to improve operational efficiency and cost control. This made the company more profitable. For the profit from operation. Profit for the financial years. The pandemic cut sales, forced store closure, and raised safety costs, causing the 2020 and 2021 fall. However, the company's ability to return and achieve considerable rise in profit for 2020 financial year show that successful recovery initiative, other than expand its e-commerce capability and reach customer through digital channels.
Its adaptability and utilization of digital technologies. The company has successfully integrated the online platform like Facebook, Lazada, Shopee, expanding its customer base and the market reach. The introduction of the mobile apps and its active presence on the social media platform has enhanced the shopping experience and increased the brand awareness. For the weaknesses, the first weaknesses is limited online presence. The company's online presence and e-commerce capability may be relatively underdeveloped, limiting its reach and competitiveness in the digital marketplace. Second is the dependency of the physical retail. The company heavily relies on brick and mortar store, which may pose challenges in the face of increasing e-commerce trend and shifting the consumer preference.
Padini can explore opportunities to expand its retail presence in both domestic and international markets. This could involve opening new stores or entering strategic partnership to reach new customer segments and increase market share. Moreover, the growing popularity of online shopping presents an opportunity for Padini to strengthen its e-commerce presence. By investing in online platforms and enhancing its digital capabilities, the company can tap into the growing online retail market and reach a wider customer base. Next is the threat analysis. As we all know, that the fashion retail industry is highly competitive, with numerous local and international players vying for market share. Padini might face the risk of losing customers to competitors which offer similar products and offer it at a lower price. Consumer preferences and fashion trends can change rapidly. Therefore, Padini needs to stay responsive to evolving customer demand.
First, by enhancing its e-commerce capability, Padini can tap into the growing online shopping trend and attract more customers. This involves investing in the online platform, improving user experience, and optimizing logistics for efficient product delivery. Secondly, Padini should diversify its product portfolio to meet changing customer preference and expand into new market segments, introducing new product categories and collaborating with popular brands such as Disney will attract a wider customer base and increase market share. Additionally, effective financial planning, risk management, and implementing strong customer relationship management strategy are essential. By closely monitoring finances, managing risk, and leveraging customer data for personalized marketing campaigns and loyalty programs, Padini can enhance customer satisfaction and drive profitability. In conclusion, by focusing on this strategy, Padini Holdings Berhad can improve its financial performance and thrive in the fashion industry.
In conclusion, Padini Holdings Berhad has shown that it can handle money in different ways. Even during COVID-19, the company has kept its efficiency ratio high, which show that it has good liquidity and operational management. Padini Holdings Berhad also improved its leverage ratio, which show that it has a better handle on its debt and more committed financially. The return on asset, return on equity, operating income margin, and net profit margin have all gone up. This improvement show that the company can increase profit and use of asset. The price to earning ratio of Padini holding Berhad change based on the how market feels. Payout per share and dividend yield show that the company has always given great dividends. Profitability and market rates are good for long-term growth and shareholder value at Padini